Hello, welcome. My name is Karen. We're going to be going through a series of workshops that talk about just understanding how money works and just some money management in general. As you know, a lot of people have gone through some difficult times. Stress is over the top sometimes, especially in the area of finances. So I pray that as you listen to this information, you will be able to take away something, and may God give you the wisdom and understanding to make some differences in your life. So stay tuned as the workshop starts. Thank you so much. Thank you so much for joining me today. For those of you listening to the recording, thank you so much. So as we get started, our class today is on cash flow and debt management. It's really important for us to grab a hold of this for a couple of reasons. Number one reason for divorce in our country is financial stress. The other reason is we need to understand what spirits might have a hold of us. So for example, one of the first steps is defining your needs versus your wants. I'm not against wanting to have things, but if pursuing things is guided by your emotions and making financial decisions to fill a void, life will be a roller coaster, and it's going to open the door for the enemy. So a couple of things I want you to think about. You need to think about how the enemy may play havoc in your life, maybe recognizing the spirit of mammon. So when we look at the spirit of mammon, it's an unhealthy need for possessions where you say, well, if I had all this money, I wouldn't need anything else. If money replaces God, that's a sign of a spirit of mammon. If you make some decisions without consulting God, so let's say God puts you at a job, you're making $40,000 a year, somebody comes along and offers you the exact type of position, but for $60,000 a year, and you don't even consider consulting God in that, and maybe you just make the decision and you're off to that job making $60,000 a year. And maybe you end up at a place where you don't like the people you work with, or the job's more challenging. And how do you know that if you would have stayed at the $40,000 job, God would have promoted you and you would have received more blessings? So sometimes we make these decisions rashly around money and finance, and we don't consider the consequences. The other way is you're a slave to debt. You continuously have this debt, and you need to recognize that you have to break that cycle. Stewarding the money you're given. Everything belongs to God. So are we stewarding? Are we doing the right things with our money? Can you be trusted with money? Do you keep secrets about money? Do you make decisions without telling your spouse? Do you hide things that you purchase? Do you justify why you spend money? Are things like gluttony, obsession, greed, selfish desires, are those things apparent in your life? So those are things to think about when it comes to the spirit of mammon. And then, of course, recognizing also the spirit of poverty over your life. It could be a generational thing where you've got family for generations was always short of money, always living paycheck to paycheck. It could be lack of education. That can change a generation too. Could be modern day oppression, right? Before we used to think about, reading in the Bible, we see the slaves, that were mistreated by the Egyptians, and how God helped them escape. And, they were a tough crowd because they wandered through the wilderness for 40 years. We don't want you to wander for 40 years. But today we look at debt. Debt is modern day oppression today, and we have to address it. Are you constantly fighting about money? Is it your number one stress in life? Is there laziness in your life? Is there idleness in your life that's causing you to stay in poverty? So sometimes our habits block the blessings that God has for us. So these are things I just want you to think about as we go through these slides today. So let's address some debt stuff. All right. So before we do that, we're going to have a joke because, laughter's good for the health. So this lady's going shopping to Toy Mart with her kids, and she says, Psalm 23 says, the Lord is my shepherd, I shall not want. So the kids are, don't bug me for toys. What are the chances of that happening when you got kids in a toy store? All right, so let's get into the nitty gritty. So Matthew 26:24 says, no one can serve two masters. Either you'll hate one and love the other, or you'll be devoted to one and despise the other. You can't serve both God and money. So if you think about it, how it plays in with a lot of people don't even realize the spirit of mammon is present in their life. They're very unaware that a lot of their decisions are dictated by money. Everything revolves around money in your life. And maybe you've never really thought about it from the spirit of mammon perspective and how that may be affecting your ability to be connected to God. So things to think about. So let's take a look at the state of Canadians. When we look at what's happening today, we've got 95% of Canadians retiring financially devastated and only 5% financially secure. So when we break down that number, out of the 95, you got 54% dependent on government, family, and friends to get them through retirement. 36% are still working. These are individuals who basically retired, had to go back to work to supplement their income. And then, of course, we've got 5% that have passed away. So you have to really think about, what did they leave behind? Did they leave debt behind? Did they leave financial ruin behind? Did they leave abundance behind? Did they leave a death benefit behind? These things can make or break a generation financially. Then we look at that, 5% that's financially secure, 4% are considered okay. So you have to just look at okay as whatever your standard of living is today. You were disciplined enough to maybe save money, maybe you had a company pension, plus your government supplements, and you were able to maintain that standard of living in retirement. But in that category, you still have to worry about how much you actually spend based on how long you live. And then, of course, only 1% of our country is totally financially bulletproof. So obviously, we'd all like to be in that wealthy category. We would have a lot of resources to do a lot of things, serve a lot of people, help a lot of people. How do we get there? How do we even get into the 4%? Well, if you think about what you're spending every single month on all those pieces of debt, if that was working for you, and you were getting a decent rate of return, that could turn your situation around and increase your comfort in retirement. So we talk about this debt as being modern day oppression today. So I want to just, give you some examples of that. So when we take a look at Stats Canada today is saying that Canadians spend $1.83 for every dollar they earn. And that was in the first quarter of 22. Now, when you look previously, it was $1.71. So it's climbing in the wrong direction. And then we also take a look at currently consumer debt has risen to 2.32 trillion. That's excluding our mortgages. That means every man, woman, and child would owe probably $21,000 each if we spread it across our population. And so we have to think about the fact that the more debt we have, the less financial resources we have. So you have to pay attention to which path are you taking. As you travel along that journey between now and retirement, one type of person will be a spender. They live in the moment. They often will buy large items that become liabilities, but even though they think they're assets, maybe a house too big, that they don't need it. They just want to keep up with the Joneses, maybe a fancy car instead of an average car. These are liabilities. They're not things we actually own on paper. The other person will have a different mentality. They want to invest for the future. They want to accumulate assets. They don't really care about what other people think and what house they live in, what car they drive. They're more disciplined with their money. So you can see, the people that tend to spend arrive at retirement broke. The people that have a savings or investing mentality arrive at retirement at least financially comfortable, if not wealthy. So you have to think, what are you doing with your money? How are you managing what's flowing in and what's flowing out? Now, I want you to just think about this. We know that everything we have belongs to God, every dollar we earn. And yes, your first payment should be to God. But when you look at after that, who are you paying first? Are you paying all your bills first and you're trying to deal with what's left over? That's not going to help you. You need to pay yourself first. The best way to look at it is you need to learn to live on 70% of your income. And you take 10%, you put it away for long term, right? Your tithes already gone. So that's 10%, 10% to long term, and then 10% to short term. And so those things will prepare you when times are uncertain, like we've seen through the pandemic, right? A lot of people didn't have emergency money. A lot of people dipped into their retirement pots. These are because our foundation is not properly set up. Excuse me. So Luke 14:28 says, suppose one of you wants to build a tower. Won't you first sit down and estimate the cost to see if you have enough to complete it? So when you think about that, when it comes to money and finance, you also have to, make decisions that are wise. You have to have some discernment. You can't just impulsively buy things. You have to look at the cost of that. You also, we grew up in a generation where, credit was at our fingertips. If you look at our baby boom generation, they grew up, the older baby boomers, they grew up, and the generation before that too, with no credit, right? Credit cards came around in the 1960s. So prior to that, people had to save for everything they wanted. So obviously they would assess, they would see how much they need to save, they would plan for it, and then, purchase that, and then the transaction was completed. Now we go purchase something and we're paying for that transaction for a long, long time. So education is key. You need to assess yourself. Remember, I talked about the spirit of mammon, is a want versus a need. You have to look at your cash flow. You have to make wise decisions there, because when you look at that cash flow, you need to address, am I making this decision because, I just need it? Or, is it something that's absolutely a necessity? And a lot of times we don't even think about how we're spending our money. So I just want you to think of this. Imagine you had $100 in your wallet, a crisp $100 bill, and you went through Tim Hortons. Do you feel the effects of that when you pull that 100 out and you actually physically give it to the gal at the counter? Yeah. But if we're just tap, 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 a lot of times we don't even look at the machine for what we're tapping. A lot of times you don't even have any kind of emotional response when we tap, tap, tap. So I have a challenge for you guys as you're listening to this. Go print off 3 months worth of bank statements and, look at those bank statements and highlight everything in there that's an insignificant purchase. Okay. So what I mean by an insignificant purchase is things that don't run your house, things that don't run your car. So the stops to pick up stuff at the dollar store, things that you purchase that are just not a necessity. Okay. Now, when you highlight that, you average the 3 months, and I will tell you that you will see, as a couple, the average couple is tapping, tapping, tapping anywhere between $500 and $750 a month, and they don't even know it. So imagine that. So let's just compare now, because if you had to think about the cost and what that's taking out of your retirement, let's just say you go through Tim Hortons and you spend $6.60 a day. I know, it's a lot closer to $8 or $10 today, but what does that cost you at a 10% rate of return out of your retirement? Well, if you're, looking over 20 years, it's $42,000. If you're looking over 20 years, it's $151,000 out of your pocket. And then, of course, over 30 years, it's almost $500,000. So you're basically drinking and eating and wasting away your retirement dollars. Things to think about for sure. So which path are you going to want to take, right? A spender lives in the moment, buys liabilities they think are assets. Person one saves, plans for the future, accumulates wealth. Okay, so think about that as we continue on. So let's say you have a credit card that you carry a $5,000 balance on that credit card. If the interest rate is roughly around 20%, your minimum payment is going to be 3.5% of that amount. So it's $175. So you've got $83 going towards interest, $92 going towards paying down that debt. If you're only paying the minimum, it's actually going to take you 107 months to pay that off, and you're going to pay an extra $3,700 in interest costs. That's 9 years. That's crazy, right? So we have to consider the impact of that. So if we take a look at being able to save that chunk of money that we're giving off to debt, right? So basically your interest cost per year would be $996. If you invested that at an 8% return over 30 years, it would compound and grow for you. And that money over 30 years would accumulate to about $172,000. So that's a pretty significant chunk out of your retirement. So you have to ask yourself, am I wanting to be more comfortable in retirement? Do I want to be able to have my money working for me, or is my money working for an institution or a credit card company? This is how the rich stay rich and the poor get poorer. Stats show it. Stats prove it. And by the way, that 95 and 5 was pre-pandemic numbers. So if you think about what's really happening today, it's a lot worse. So the wicked borrow and do not pay, but the righteous give generously. Now, we all have circumstances, especially over the last handful of years, where we've been faced with things and we just don't know what our choices are, what our options are. Now, there's one thing about taking responsibility for your debt, and there's another thing about running away from it, right? So I think we do need to be able to address that. So I'm going to show you some examples of what's really happening in our money system today. Because when we look at our money system today, we really have to understand how money works and what's really happening with our money. So let me share something with you. This is just my personal opinion about how money flows and how our financial system here in Canada is actually broken and it needs to be repaired. So let's take a look. When the federal government decides it needs more money, for example, during the pandemic, where the country's expenses were larger than normal, right? A lot of people were on CERB and, the government was giving grants and, helping businesses and so on. So they're printing money. That's what happens, right? The government will go and print money. And, that money now is a liability, right? So that the Treasury, the government of Canada will issue bonds to the global market to guarantee the rate on that money so that they can secure it, right? And print this money. Now, however, the more money we print, the more we send that out to the global market, it's going to weaken the value of our dollar. So then what's next? Well, the Bank of Canada now lends this new money back to the banks at compounded rates. And then, of course, as the debt continues to skyrocket, as I talked about, excluding mortgages, we're at $2.3 trillion. And by the way, let me just tell you, $1 trillion is a lot of money. If you were born today and you lived to age 80 and you spent $34 million a day, it would take you all the way to age 80 just to go through 1 trillion. And we have 2.3. This is what we're leaving for the next generation, a mess, right? So the debt continues to increase, it compounds, the amount owing skyrockets. To compensate for this, the government increases tax rates to the average Canadian to pay for the interest on this debt. The real money paid by Canadians is used to make even more money for the banks, the government, and the private lenders. So the result is increased inflation. Canadians are spending money per month and they're feeling the effects of that. And so therefore, they pull back on that spending. It slows down the growth in the economy, right? And then, of course, we also have to look at the reality that when the banks loan out this money, this printed money, which in theory didn't really exist in the first place, to Canadians, they loan it to us in the form of debt. And so let's take a look at that debt now. It could be a car loan or a vehicle loan. It could be, the purchases you make on your credit card, or it could be a mortgage, let's say, and this tends to be the largest asset that people own. So if we take a look at that debt, and let's say, for example, you want to actually pay all this down, if you don't have a strategic plan, it can often be a huge financial burden. And by the way, do you know what the Greek definition of mortgage is? Well, mort stands for death and gage stands for pledge or grip. So death pledge or death grip. Isn't that interesting? Hey, how many times do people pay for their homes over and over? And again, this is why banks get richer and Canadians are getting poor. So let's look at some debt solutions. So of course, this is like from worst order to best order, okay? So orderly repayment of debt. Basically what they'll do is a trustee will negotiate with your creditors, stop the interest rate, and then they schedule a payment. You make that payment back to your trustee. They divvy it out to all the companies, but the companies aren't charging you interest. What I don't like about this, and some provinces have stopped orderly repayment of debt because it doesn't make sense for the consumer. The moment you go into that process, well, your debt's probably already affected your credit. So you're already probably at an R7 at the time this happens, but then you become R9, and then it stays on your credit for 7 years on your credit bureau. Now, if it takes you, let's say 10 years to pay this off, then you still will see it on your credit bureau until 7 years from there. So if it's 10 years till your last payment, then another 7 years. So that's 17 years. It's a negative hit to your credit, which is not a good thing. Then, of course, there's bankruptcy. Now, it used to be a Band-Aid solution. People just used this as a way to buy stuff irresponsibly. They go bankrupt. You know, there are circumstances that have happened. We looked at through COVID, businesses shut down, people's finances were a mess. There were some crises that happened because of that situation. But sometimes people are irresponsible when they have chosen to do bankruptcy over and over. Government changed the rules around that, and you know, they've set some structure in place. So when you file bankruptcy, it's also an R9 rating, right? You have a discharge period, which is usually a 9-month period. They figure out what your payments are, but you can't really have anything extra. You can't have emergency savings. You can't have life insurance protection on your family. Typically, those things kind of all get squandered away and the money goes to the trustee for those 9 months. You have to report every single month your cash flow, money in, money out. If you get a better job to try and improve your situation, your payment goes up and extends out. So it's not always the best solution. My choice or preference when I help people in this area, I send them to somebody that I can trust that does consumer proposal. So let's say if somebody had $100,000 of debt, the consumer proposal trustee person will negotiate that debt with the creditors, put out a vote, and let's say they get all of them voting, and let's say they can reduce that debt down to 30,000, then they figure out a payment schedule for you. That payment schedule is set. You know that, let's say at the end of 5 years, you're going to be done. And yes, it is an R7 rating, but as I said, your credit's probably smashed at that point anyway, but you have the ability to rebuild credit within 2 years. So we've had people who have done consumer proposals, you know, started managing their payment schedule. It shows a good payment history over 2 years and they can qualify for a mortgage. And then, of course, the other one is the roll-up strategy, which in that strategy, it's really just for you to be able to manage and take care of your debt, right? And that's you taking responsibility and paying it off strategically until it's gone. So I'm going to show you an example of that. So let's say we have this individual or this family and they have typical debt, right? They've got mortgage, you know, bank, line of credit, vehicle loan, MasterCard, Visa, a brick card, and Home Depot. So they're paying $355,000 and their payments are $2,100 per month. Excuse me. And so if they continue in their payment structure in the order they're doing it, they're going to pay $117,000 of extra interest paid, and it'll take them till September 2039 to pay off that debt. So how are we going to fix that? How are we going to help those people get ahead financially? So there's really two ways. You know, you need to be able to increase your cash flow, which people either have to go get better jobs or they get 2 or 3 jobs, or they have to spend less. Now, sometimes earning more means time away from the family, higher stress, you know, it's harder on your body, your mentality, your family environment. Maybe the easiest way is to be able to, you know, find the dollars inside where you're spending. So remember I said that homework exercise? If you look at that homework exercise, you will find some money. And let's say you know, out of that average couple, let's say they'll use $500 towards their debt. So, oops, sorry. So 2 Kings 4:7 says, she came and told the man of God, and he said, go sell the oil and pay your debts, and you and your sons will live. So just think about that. God doesn't want us to be in debt. God wants us to be disciplined. God wants us to be able to manage and steward what he gives us, right? So let's see what we can do to get rid of that debt. So what we're going to do is we're going to focus paying the smallest balance first, right? We're going to apply that $500 to the existing payment, which is this $2,100. And you're going to now have $2,642 going towards debt. We're going to focus on the smallest balance first. So I want you to see that red box that I've got at the bottom of your screen. You can see right above that line under the Home Depot category, that base payment. You see the minimum payments are being made all the way along. You don't want to ignore that because that will affect your credit. But we're going to apply that extra money strategically on the first debt first. So let me show you that. So here we have, your payment on your Home Depot, which was $10, right? And we are applying that debt to the balance. So obviously that $500 of debt, you could see right here, wipes out this $256 payment. The remaining balance goes towards your brick, right? So remember, we've got $500 extra. The Home Depot payment was $10. The brick payment was $51. So that's why it's $561. It gets paid off until it's done 5 months from now, right? And then we switch over. So the $82 Visa payment added to $561 is the $643, and it continues until 13 months from now, it's paid off. Now think about that. Let's just call it a year, 13 months, right? When's the last time you paid off 3 credit card debts in 13 months? See, you have to look at it. If we talk about the flesh, we like immediate gratification, right? The problem with focusing on the highest debt first, it's typically the larger amount, it's typically the biggest interest, and it takes us a long time to see the needle move. And so then we end up giving up that strategy of trying to focus on that one. We do a little here, a little here, a little here, a little here, and it takes longer to move the needle. This way, it's easier and you start to see it happen and you get motivated to get it done. So you just continue that same process, and then you've got your MasterCard paid off in 21 months, right? So that's a significant chunk of debt that you eliminated. So let's just look at that. So if we include the mortgage, that means we're debt-free in 16 years instead of 20, and we've reduced that interest cost down to $68,000, right? So basically, we would have paid $117,000 of debt before. That's a $48,000 savings, and it's freed up money now. We can take that $2,600 and start applying that to retirement. Or, yeah, he's pretty happy. Or you can look at the idea of, maybe just leaving the mortgage intact and then just saving the difference after you've paid that off. So if we take the mortgage payment out of that 2,600, it would leave us with 813 plus the 500. So we're applying $1,313 to that debt. The debt is 36,000. In the interest costs, for that time frame, if they would do it on their own strategy, after we apply it, we save a significant amount of almost $25,000, and we've paid it off way sooner. So just a scripture in Deuteronomy, I'm not going to read the whole thing, but Deuteronomy 15, 1-6. So it actually says in the Bible, it's funny how, debt stays on your record for 7 years. It says every 7 years, your debts must be canceled. So, our world was built on biblical principles. It's just people have lost track of that, right? And so in order to really honor God and do the things we're supposed to be doing, we need to strategically get rid of our debt. Depending on your situation, maybe you need to use the consumer proposal path to be able to help you and then reset your life. That's okay. But then you be diligent and disciplined thereafter, right? I believe just from reading things in the Bible, there's over 2,300 verses on finance. There's the word money, or different forms of how it's talked about in the Bible, is written more times than the word heaven and hell. So God actually wants us to deal with our finances. And I believe that he would bless you, if you are faithful and you live by these commandments, right? So where do you want to be? Well, let's say you focus on them paying off everything and you've got that $2,600 to save till retirement, or you only have $1,300, but a longer time period to save because you're out of debt sooner. So let's take a look at that. So if we take a look at that, after the mortgage is paid, it shows here we've got 11 years. You can see that circle there. I lost my mouse. There we go. And then, of course, at an 8% rate of return, we're saving that $2,642 monthly. That grows to $556,000. So how many of you would love an extra $500,000 in retirement with the same money you're spending today? Exactly. So save and invest that and have a good chunk of money in retirement, right? Or you start a little sooner because you're not worried about making the mortgage payments, just part of your budgeting, and you save that $1,300 per month over the next 20 years, and it accumulates to $700,000. So that is awesome, when you think about what chunk of money you'd have set aside for retirement, right? So you have to make that decision for yourself, which one would you choose? You want 500,000, you want 700,000. It's up to you. So for the Lord your God will bless you as he has promised, and you will lend to many nations, but borrow from none. You will rule over many nations, but they will not rule over you. And that's Deuteronomy 15, 6. So just to refresh your mind, God gives us the money to steward. You have to think about the path and the impact of the path, right? So again, person one has these habits that open the door for the enemy, and suffering occurs and they arrive at retirement broke. And, it's just this continuous habituous cycle that they go through, and they're stuck, and enemy has grips on them because of that. And then the other person, because they invest in God's kingdom, right? They do their tithe, they use their money wisely, they steward what God's given them. They're going to be blessed, and it gives them the ability to bless others. And they arrive at retirement either comfortable or wealthy. So lastly, I just want to talk about, if you're going to build something, you need to build and have a solid foundation. The Bible talks about, the Lord being our solid foundation. Well, it's same in the financial principle. You need to have a solid foundation. So if I were to ask you what's your greatest asset, most people would say their home, but your greatest asset is your ability to earn income. So think about what you make on an annual basis, multiply that by 40 years. Something happens to you, that money's gone. It could put your family into poverty. They could lose everything. So you need to be able to protect not only your assets, but your income also. And then the next step is debt management. You have to get that under control. If you don't get that under control, you're going to have less resources to be able to function with. And eventually it'll compound so great, it'll start to squeeze your budget so tight, you probably will drop that first foundation, which isn't good. Right? And before you can move to, building wealth for retirement, you have to have these pillars in this order. So building an emergency fund, in my opinion, you need to handle your debt, do the roll-up strategy, consumer proposal, and start saving and having your protection in place and build up that emergency fund. You should have 6 months, best case scenario, of your take-home pay, or at least 3 months of your take-home pay, so that you can comfortably live and not be, worried and tossed around by, emergencies that occur, right? And then after that is when you build that retirement picture. So I really hope that this has helped you. I hope that you have a great opportunity to learn, and you're able to take away some things and just make some changes in your life. And if you do need help in any area, you can always reach out to the platform you watch this on, and I'm sure they'd be willing to help you out. So thank you very much, and have a great day. God bless.